Okay, welcome to part two of the farm balance sheet for AAE 320. My name is Paul Mitchell. I'm a professor of Ag and Applied Economics at UW-Madison. In this section, we're going to talk about the asset valuation problem. There's really two traditional methods for when you are developing a balance sheet. On the left-hand column are all your assets, but where do you get those values for those assets? What we talk about are a cost basis and a market basis balance sheet. How you come up with the value of those assets is using the cost of what it took you to buy them, minus any depreciation you've claimed, or the cost it took you to produce them for farm assets you produced. Let's say a milk cow that you raised. That's the cost basis balance sheet. The market basis balance sheet uses the current market value, not the cost, but what it's actually worth today, the day of the balance sheet, minus any selling costs. So market basis balance sheet is a market basis. The issue with that is that the asset values can change, and so your equity can change in response to the change. So market value can change due to inflation, just overall price up increasing and decreasing. So like land goes up in value generally, but it can go up and down, up and down. That means your equity will go up and down as the assets all go up and down in value, reflecting these things like inflation and overall land values. The assets will increase and decrease. Your liabilities don't change. So as the assets go up in value, the equity increases. As the assets go down in value, your equity decreases. And so what that is it gives you an accurate value of the business and the collateral available for loans. And so it's used by lenders, but it also it's subject to market pressures, market fluctuations, and it can hide your problems as a manager. Your equity can be going up because your land value is going up, not because you're making money as a retained earnings. And so equity keeps increasing, but you're actually a poor manager. And that can happen. And when you're using a market basis balance sheet, you miss that. On the other hand, the cost basis, what it focuses on the cost it took to produce them, or the cost when you bought them, minus any depreciation. It's much more conservative. It follows the generally accepted accounting principles used for other businesses. The only way your equity changes is from retaining your earnings, not from farm asset price changes. And so it is a way to evaluate your ability as a farm manager as opposed to an investor. The market basis captures your returns as a manager and an investor, whereas the cost basis balance sheet captures only your equity increases due to being a manager. So it's good for that, but it misrepresents the true value of the business. You might have land you bought for $6,000 an acre. It's now worth $8,000 an acre. Your cost basis balance sheet will not capture that gain in land values and the subsequent increase in equity that would generate. The Farm Financial Standards Committee is an association of farm accountants, really, and what they actually recommend doing in agriculture is doing both methods. A market basis balance sheet with the cost basis for as a separate appendix or attached schedules, or maybe as footnotes at the bottom, or to do double columns, both the cost basis and a market basis. And so you get both ways. And it's really to help track the value of the business as a whole for lenders' uses, and from the farmer's perspective, the value of the business and your true equity. And then the cost basis is very useful for understanding your ability as a farm manager. So here's an example from Iowa State University. It's dated, December 31st of 2017, but you see the double column here, cost valuation and market valuation. Liabilities are always at the market value, but the asset values are at both. And what you'll see here, they're all the same except for here in this sheet, these three. The machinery and equipment, the cost basis is lower than the market basis. Buildings and improvements, the same thing. The cost is lower than the current market value of the buildings and improvements, and then of course the land. You bought it for $800,000, but it's now actually worth over $1 million, and so that's where the difference is. And so it gives you two different equity net worth values. The net worth of the farm lot is $1,666,000 or $1.82 million. So you can see which balance sheet valuation method you use for the assets gives you different equity levels. So that's an example here. But the real thing to note is both methods actually use both methods. And so it might be a cost basis balance sheet, but what they actually recommend is for some assets to use the market value. It might be a market basis balance sheet, but for some assets, they actually recommend to use the cost basis. And so here's several of them here, and they lay them out. the raised grain and feeder livestock, the animals on the farm or the grain you grew yourself, both the market basis and the cost basis balance sheet recommend using the market basis to value those assets. But purchased ones, they actually recommend on the cost side to use whatever one's lower, the cost or the market value. And so if you bought some grain and it goes up in value, they recommend using that higher price. If you bought some grain and it goes down in value, they actually recommend using, I actually said that wrong. If you bought some grain and it goes up in value, you stay with the original purchase price. If you bought some grain and it goes down in value, you use its current market value. And the other ones, but on the market basis side, things like accounts receivable, prepaid expenses, and investments in growing crops, they actually recommend using the cost, what you paid for these prepaid expenses, not their current value. So if you bought some fertilizer, you actually use what you paid for the fertilizer, even if it's, particularly it's already potentially applied on the field. You use the cost, not its current value. You might have spent 40 cents a pound for the fertilizer. It is now worth 45 cents a pound. You don't use the market value of that fertilizer, even in a market basis balance sheet. And you can see the other one I want to focus in on is breeding livestock. This would be like milk cows or bulls. You actually, on the market basis, you use the market value of all those animals. But for a purchased one, the cost basis balance sheet uses the cost. The market basis balance sheet uses the market value. But the raised ones, there's something called a base value here. And I'll go into that in a second here. We'll explain what I mean by that base value. So we've already talked about this. When you talk about how things change in value, you can use the minimum of the cost. Crops are growing in the fields. Even the cost basis, they like to use the cost, even in the market basis balance sheet. And it's a more, even there, it's just, you don't count your chickens before they hatch. If you have a crop in the field, say it's July 1st and there's corn growing out there, you don't use in a market basis balance sheet the expected value of that grain. You assume you use the cost of what it took you to put that corn in the ground, not assuming it's going to be 180 bushel per acre and $3 corn or something like that, and come up with the market value of that cornfield as part of your business assets. You use the cost. Here's the cost on the base value side, on the raised breeding livestock. Technically, what you would do is say you've got 10 milk cows. Each one would be tracking the costs separately over the years. This one tends to be more sick, and so gets more shots, has maybe more veterinary bills. The other ones are healthier, and you track each cow differently. That's just unrealistic for a farm, especially once you get more and more animals on the farm. It's just overly detailed. And so really what a lot of farms do in these situations, if they are trying to do a cost basis balance sheet with their accuracy, they would use for raised breeding livestock to kind of create what they call a base value for each sort of age and type of animal, each category of animal. So a milk cow that's after her first calf has been born, a milk cow after her second calf is born. Those two might be two categories of cows. The first one has all of its costs accumulated over its lifetime, depreciated. The other one has a longer lifetime and has a different set of costs. And really what it is, it's the average cost of production for a typical cow for this type of raised asset, of first lactation or second lactation milk cow. It's just an average cost. It's a much simpler way than having each cow tracked differently. That's just